Joe, I'll just start with you on the tariff back and forth with the EU. I guess, what's the advice while this plays out?
I think hold on to your seats, because this back and forth that we've been dealing with is unfortunately just part of the norm. Now, we do think we're going to end up with baseline tariffs of around 15%. But Kelly, until we get there, these negotiations, it's going to create some volatility in the markets. It's going to create a little bit of anxiety. And I think there is risk here, at least in the near term, that markets bear the brunt of that.
But if there's going to be volatility and risk, I mean, this has been the most placid, content market, Joe. It just, unless you're in the healthcare space, it's like there's no problem. So why wouldn't we be seeing that now, unless you think we're going to have a repeat of April where come, I don't know whether it's going to be Friday, Monday, what the D-Day really is, all of a sudden we have an 8% correction?
I think the reason markets are at these levels and flirting with all-time highs on a daily basis is driven really by the underlying fundamentals. I mean, as you mentioned, we've had very resilient and strong economic data. Of course, when you take a look at earnings season, it's coming in much better than feared, and we are expecting reacceleration into 2026. Of course, we can talk about the Fed, but by and large there, once we get past this hold, we do think there is going to be more accommodation coming from the Fed. That is what's driving markets to these levels. The underlying fundamentals are strong. Make no mistake of that. But in the near term, Kelly, just like we saw in April, these headlines and this back and forth and this negotiation around tariffs and agreeing to what that ultimate tariff rate is going to be, it is going to create some volatility in the markets, especially when you have valuations at these levels. There's just very little room for error.
Yeah, no, I do think, Sarah, that the decent economy, not sure quite what adjective to use, better than expected, better than feared, okay, maybe better than okay. I mean, that's a big part of why the market has held up and is doing so well. What do you expect to play out in the coming couple of quarters in terms of the economy and the Fed and all the rest of it?
Sure. So I think we got some better than expected data last week, but I don't think that should be conflated with the same that the economic data is good overall. So I think we've still seen some deceleration on trend, and we expect that to continue in the second half of the year. If you look at the inflation picture, we're just now beginning to see some of the effects of tariffs. We think those will ramp up further. So that's going to put pressure on real incomes as that inflation rises. And at the same time, we're continuing to see the labor market lose momentum. And so as we see slower hiring, as we also see some pressure on nominal wages, that's going to create a real income squeeze for households. And we think keep consumer spending growing at a rather middling pace of just around 1% in the second half of the year.